And welcome to another episode of A Gold Dealer Gives Advice. So I recently had a chat with one of my customers, and she said to me, she's like, "What sort of premium should I be paying for gold, like sovereigns, etc.?" And I said to her, "There's not really such a thing. There really isn't. So you're going to go through times where the premium is going to be really high, relatively speaking. So I remember reading, I think it was from a very well established dealer in the UK. They put it on their website that there were times that the premium was 10% over spot for sovereigns. Um, I may have to double check that, but that's the figure that sticks in my mind. So if I am wrong, don't hold me over the coals. And there's going to be times where the premium is very lean. So when I started trading coins, I was buying small gold, so we're talking 10th gold coins, and I was picking up for 3% over spot. They quickly changed it when they cottoned on that I was flipping and other people were flipping these coins, and naturally they raised the premiums to the relative amount. Now, what I think is happening, and I've been saying this for a very, very long time, is that as gold goes up in value, in price, a lot of people get kind of pushed out of the market. Like a 1 ounce coin these days is not what a 1 ounce coin was 5, 6 years ago when I was buying. I was picking them up for £700 or £800 an ounce. I could afford that. At the time, I was working a night shift and I could buy one a month, and it was great. And then we had kind of the Brexit referendum, and that completely changed. Gold went crazy. So the premium naturally is going to change. It's all about supply and demand with these things. And if no one can afford it, or very few people can afford it, naturally the premium is going to come down. If there was, say, a 5% premium on 1 ounce coins, but there's no buyers, that signals to someone like me or other dealers that the premium needs to be less. Now, there are people who can afford it, but the majority of people can't. If you're working an average job, could you buy one a month if you saved really hard? Nah, you couldn't. You couldn't do it. Could you do it at 700? Yes, because I did it myself. So what you're going to find is that over time, depending on the market forces, that's going to dictate what the premium is. So having this rigid idea in your head of what you should be paying, it doesn't serve a purpose. It really doesn't, because you're going to get stuck on this idea and you're going to miss out on buying coins that over time, coins or bars that over time that you'd imagine they'd go up in the long run. This isn't a short run game. This is about preserving wealth. So you should be thinking in time frames of 5 years plus. Now there are people like myself who do it super small time frames, but I buy for less than other people, and people come to me because I'm someone who provides liquidity. I act as the middleman between the buyer and the seller. My time frames, although I run a hybrid approach where I have reserves, I'm not considering 10, 20, 30 years, 5 years. I'm thinking about, I need to get it in and I need to get it out, and I take a tiny sliver of that. So for example, I've got a deal coming in. If I make 2% on that, that's okay. That really is okay for me. It's money in, money out. Now that 2% will be off around 4,500. So just to work that out quickly, so divided by 100, I'll make £90 off that deal. It's not, the margins are tiny, but £90 for me is close to what I'm aiming for in a day. So that covers one aspect of why you shouldn't really focus on what you should be paying, because over time they're going to change. It is going to go up and it is going to go down depending on market forces. Now, the second thing I wanted to kind of address in this video is that you're going to have times where you're in a buyer's market and you're going to have times when you're in a seller's market. So when you're in a seller's market, you're not really going to have any control over the premium you pay. So in a seller's market, there's going to be lots of buyers. Maybe social media is going crazy and they're saying gold's going to be the next big thing. What you're going to see is the news agencies, they're all going to jump on the next big thing. And the reason they do it is because they make money from it. And it doesn't matter what it is. The flavor of the month might be gold. It might be oil. It may be real estate trusts. but it's always going to switch from thing to thing depending on where the economy is. Now, I think gold will come back into the fore, and say the big media pushes it, you're not really going to have a choice over what you pay. So, for example, someone like myself, when I know all the cards are in my hand and it's all in my favor, I'm literally just going to say that's the price, and you can take it or leave it, because I know that if you don't take it, someone else will. So if I'm putting small gold up at spot plus, on some occasions, spot plus 15, 20% on the really small bits, I know they're going to sell. And it doesn't matter if you say, well, what if I buy the lot? So what? What if you do buy the lot? In that type of market, I cannot source it quick enough. So you buying a lot, I'm doing myself a disservice. Now, I'm not saying that to be rude or to put people off, but overall, I've got to bank on these good times because I've got to save for the bad times. Now, I've had it for also where people said cash waiting or the offer expires tomorrow, and this makes someone like me laugh. It's like, okay, well, what does that even mean? You're coming to me. I'm not short on the money. It doesn't really matter. But in these types of times, the premium is going to be very fixed. When there's more buyers than there is sellers, the premium is what it is, and you're not going to have any control as an individual buyer over that. Now, you could say, let's buy in bulk, but even if you go to the bigger guys, they don't have the capacity to sell at the levels than the smaller guys. The larger up you go in the chain, the harder it is to get a discount, because on occasions it's a different kind of mindset and business model. They might have 100 Krugerrands come in. They're paying spot plus 2 for them to get them in, but they've already got someone to sell for spot plus 2.5 or spot plus 3. They are making a tiny fraction, but they know that will cover a day or 2 days worth of their operations. So that's why they do it. And if they don't sell it quickly, it's going to go. Our spot price could potentially go down. Sorry, and that's the game we play. Now, if you're in a buyer's market, which we have been in probably the last 6 months, it's getting pretty brutal. It's getting pretty dog eat dog. You're going to have more control over the premium you pay. Now, for someone like me, I had it recently. A gentleman turned around and I thought he was quite rude, so I had a little pop at him. I shouldn't have done it, but it made me feel good about it. You know, I was like, no, I am going to defend my corner, because you can't just offer rubbish prices to me and expect me to like, yeah, you know, it doesn't work that way. But you're going to have more people who will say, can I have it for this? And then I've got to go back to what I paid, and I've got to look at the premium. I've got to judge it against the market, and I've got to see what I've got coming in and what I've made for the month, and if I've covered my bills or not. And the reality is, if I haven't covered my bills, it's been very lean for that month, I probably will come down a bit. And that just is what it is. I don't take it badly on 99.9% of occasions. I just say, I look at it from a very rational viewpoint. It's like, well, it's probably beneficial for me to kind of come down so I can re-roll the dice in terms of what I have for my cash flow. And that's okay. So you're going to have times in a buyer's market where, you know, the premiums are going to be lower. And you're going to have times in a seller's market where the premiums are going to be pretty much fixed over spot. And you're not going to have control over the latter, but you're going to have control over the former. Now, if someone says to me, I'll buy for 97% spot, which I think happened the other day, the chances are I'm going to laugh at you. And I don't mean that in a rude way, because I don't buy that. I don't pay that myself. I am someone who will pay spot and then I'll move it. When you're in this market, though, when you are selling, if you're selling into a seller's market, honestly, I'll sell whatever assets you have that are up, or I'd use whatever cash reserve you have that are up. The last thing you need to be is have your gold as your last line of defense and you're in a seller's market, because you will lose money. You will lose money if you've done it in a short run anyway. If you bought 10, 20 years ago, it doesn't really matter. The cards are in your hands. But if you bought recently, you will lose money, and it's going to be pretty brutal. And the amount of money you lose all depends on what you bought as well. So if you've bought bullion, you're going to take a little haircut. If you bought semi-Numi, it's going to be very difficult, and the price is going to start reverting down to closer to what the bullion coins are going to go for. You want to be a buyer on this occasion. So in terms of what spot you should be paying, just pay a fair rate over. You're going to have good times, you're going to have bad times, and it's going to even out. The goal isn't in 6 months or a year. You should be using paper products if you're doing that. The goal should be in the long run, and that's how you're going to build your wealth, and you're going to do well out of it. Anyway, that's it for today. I hope you've enjoyed the video, and I'll see you on the next one.